Hence, we discussed the profit maximization objective for increasing the shareholders' profitability or profitability of a firm, and also we discussed about the flaws suffered with this objective. And now, in this video, we will discuss about the wealth maximization decision criterion, which takes into consideration all the flaws of profit maximization. It incorporates time value of money, the risk factor, and also the quality of benefits, and also the time of the benefits. So this wealth maximization decision criterion, it is also known as value maximization or net present worth maximization. Value maximization is almost universally accepted as an appropriate operational decision criterion for financial management decisions because it removes the technical limitations which characterize the earlier profit maximization criterion. Its operational features satisfy all the three requirements of a suitable operational objective of financial course of action, that is, the exactness, quality of benefits, and time value of money. The value of an asset should be viewed in terms of the benefits it can produce. The worth of a course of action can similarly be judged in terms of value of the benefits it produces less the cost of undertaking it. A significant element in computing the value of a financial course of action is the precise estimation of the benefits associated with it. The wealth maximization criterion is based on the concept of cash flows generated by the decision rather than accounting profit, which is the basis of the measurement. The measurement of these benefits in the case of profit maximization criterion. Cash flow, which is a precise concept with a definite connotation, measuring benefits in terms of cash flows avoids the ambiguity associated with accounting profits, which is the first operational feature of the net present worth maximization criteria. The second important feature of wealth maximization criterion is that it considers both the quality and quantity dimensions of benefits. At the same time, it also incorporates the time value of money. The operational implication of the uncertainty and timing dimensions of the benefits emerging from a financial decision is that adjustments should be made in the cash flow pattern, firstly to incorporate risk, and secondly to make an allowance for difference in the timings of benefits. The value of a stream of cash flows with value maximization criterion is calculated by discounting its element back to the present at a capitalization rate that reflects both the time and risk. The value of a course of action must be viewed in terms of its worth to those providing the resources necessary for its undertaking. In applying the value maximization criterion, the term value is used in terms of worth of the owners, that is, the ordinary shareholders. The capitalization rate that is employed is therefore the rate that reflects the time and risk preferences of the owners or suppliers of capital. As a measure of quality or the risk and timing, it is expressed in decimal notation. A discount rate, say, of 15% is written as 0.15. A large capitalization rate is the result of higher risk and longer time period. Thus, a stream of cash flows that is quite certain might be associated with a rate of 5%, while a very risky stream may carry a 15% discount rate. Hence, for the reasons discussed, the net present value maximization is superior to the profit maximization as an operational objective. As a decision criterion, it involves a comparison of value to cost. An action that has a discounted value reflecting both time and risk that exceeds its cost can be said to create value. Such actions should be undertaken. Conversely, action with less value than cost reduce wealth and should be rejected. If, in the case of mutually exclusive alternatives, when only one has to be chosen, the alternatives with the greater net present value should be selected. Hence, it can be seen that in the value maximization decision criterion, the time value of money and handling of the risk as measured by the uncertainty of the expected benefits is an integral part of the exercise. It is moreover a precise and unambiguous concept and therefore an appropriate and operationally feasible decision criterion for financial management decisions. It would also be noted that the focus of financial management is on the value of the owners of suppliers of equity capital. The wealth of the owners is reflected in the market value of shares. So, wealth maximization implies the maximization of the market price of shares in the market. In other words, maximization of the market price of shares is the operational substitute for value or wealth or net worth or net present value maximization as a decision criterion. What is relevant is not the overall goal of a firm but a decision criterion which should guide the financial course of action. Profit maximization was initially the generally accepted theoretical criterion for making efficient economic decisions using profit as an economic concept and defining profit maximization as a criterion for economic efficiency. But in current financial literature, it has been replaced by the wealth maximization decision criterion because of the shortcomings of the former as an operational criterion, as it does not take account of uncertainty of risk, it ignores the time value of money, and it is ambiguous in its computation. Owing to these technical limitations, profit maximization cannot be applied in real world situations. Its modified form is the value maximization criterion. It is important to note that value maximization is simply extension of profit maximization to a world that is uncertain and multi-period in nature, where the time period is short and degree of uncertainty is not great. Value maximization and profit maximization amount to essentially the same thing. However, two important issues are related to the value maximization, namely economic value added and focus on stakeholders. What is economic value added? It is a popular measure currently being used by several firms to determine whether an existing proposed investment positively contributes to the owner's shareholders' wealth. The EVA is equal to after tax operating profits of a firm less the cost of funds used to finance investments. A positive EVA would increase owner's value or wealth. Hence, only investments with positive EVA would be desirable from the viewpoint of maximizing shareholders' wealth. For example, assuming an after tax profit of Rs 40 crore and associated costs of financing the investments of Rs 38 crore, the EVA is Rs 2 crore, which is the difference between the 40 crore and 38 crore. With a positive EVA, the investment would add value and increase the wealth of owners and should be accepted. The computation of the after tax operating profits attributable to the investments under consideration as well as the cost of funds used to finance it would however involve numerous accounting and financial issues. The merits of EVA are its relative simplicity and its strong link with the wealth maximization of the owners. It prima facie exhibits a strong link to share prices, that is positive EVA is associated with increase in prices of shares and vice versa. However, EVA is in effect a repackaged and well marketed application of the NPV technique of investment decision, but it is certainly a useful tool for operationalizing the owner's value maximization goal, particularly with respect to investment decisions. And focus on stakeholders. The shareholders' wealth maximization as the primary goal, notwithstanding, there is a broader focus in financial management to include the interest of the stakeholders as well as the shareholders. Who are stakeholders? They are the employees, the customers, suppliers, creditors, and owners, and others who have a direct link to the firm. The implication of the focus on stakeholders is that a firm should avoid actions detrimental to them through the transfer of their wealth to the firm and thus damage their wealth. The goal should be preserve the well-being of stakeholders and not to maximize it. The focus on the stakeholders does not, however, alter the shareholders' wealth maximization goal. It tends to limit the firm's actions to preserve the wealth of the stakeholders. The stakeholders' view is considered part of its social responsibility and is expected to provide maximum long term benefits to the shareholders by maintaining positive stakeholder relationship which would minimize stakeholder turnover, conflict and litigations. In brief, a firm can better achieve its goal of shareholders wealth maximization with the cooperation of rather than conflict with its other stakeholders.